Hello and welcome to today's Delta Credit Tip. Today is a fantastic episode. I can't wait to get this out. Today we discuss the Delta Principle. Okay, you're ready to buy your house, you got the credit cleaned, you're approved, you picked your house, everything's great. Now we got to come down with a down payment. And your lender's telling you one thing, your realtor's telling you another thing. We're going to tell you the truth. And we're going to show it to you, and it's going to absolutely blow your mind. So stay tuned for today's Delta Credit Tip. Hello, welcome back to today's Delta Credit Tip. Super excited about today because today we break the myth. Okay? Today we're going to talk about the Delta Principle, and we coined it that because I made it up. I can do that. Right? And today we're going to talk about that down payment on your house. All right. The thing about the down payment is it can affect a lot of things. It can affect your monthly payment. It can affect how long it takes you to pay off the house. It can affect how much you actually pay for the house. It can affect the insurance that you pay. It can affect all kinds of things. Okay. So today what we're going to do is we're going to spell out a couple of scenarios. Okay, and we're going to show you a different method. Okay, contrary to what you might hear, we're going to show you the numbers so that you can see the accuracy in it. Okay, remember, having good credit has nothing to do with your score. It has to do with the behaviors. And credit repair has to do with fixing mistakes that you've made. But good credit behavior is about going into these relationships with the right behavior and maintaining them with the right behavior. So what this is going to do is show you a better way to go into a mortgage than what you maybe have been previously taught. Okay. And the cool thing about this is that at Delta, this big red triangle that's our logo, it's a mathematical symbol, right? It's a mathematical symbol that represents Delta, which is a symbol for change. And the cool thing about it is that this does not require a whole lot of change on your part, but it will make a dramatic change in your mortgage.
So what I want you to do is I want you to go, if you're going to follow along, you can go to bankrate.com. There they have a really good amortization schedule calculator that I really like. And so you can follow along if you're so inclined. But what we're going to do, like I said, we're going to give you three different scenarios. The first scenario is just going to be kind of a baseline situation. But then we're going to go through and we're going to show you the truth behind this new Delta principle and how we prefer to do things this way. So let's start with our first example. So if you go to bankrate.com, the best thing to do is you just go over mortgages here, go to amortization calculator, right? And then what will happen is that it'll basically bring up the screen that we were just looking at. So we're going to go over the scenario where we're going to basically buy a $200,000 house, right? The rate is going to be 4.5%, which is really irrelevant. And then the term is 30 years long. And then you hit the calculate button. And what you will see is that your principal plus interest payment is $1,013.37. This is your principal, like I said, principal plus interest payment, no taxes, no insurance. It's a 30-year note. Okay, so as a 30-year note, what you will notice is that this is going to be finished in August of 2049 because it's a 30-year note. Now, the stated rate, as we mentioned, is 4.5%. Okay, that's what they call the stated rate. They state that they're going to charge you 4.5% to do this loan. But that's not actually what you pay. What you pay over the life of the loan is what they call the effective rate. In effect, what you're really paying is blank. And for most mortgages, it's 82.5%. How does that happen? Because of the way they calculate interest. If you look at the total interest paid over the life of the loan and you divide $164,813.42 by 200,000, you'll find that your effective rate is 82.4% because this is what you actually pay. And while that may be something that will blow your mind. It is not even close to what's going to blow your mind in a few minutes. So you tell your lender, I don't want to pay $164,813.42 in interest over the life of the loan. I don't want to pay $1,013.37 a month. How do I get past this? And your lender or your realtor may give you the advice of saying, well, put down a large down payment. As a matter of fact, if you put down 20%, you can avoid paying private mortgage insurance. You can lower your payment and reduce the amount of interest that you pay over the life of the loan. And to a certain degree, this is true. But is it the whole truth? Let's find out. So we're going to go to scenario 2. So in scenario 2, we're going to do what the lenders ask us, and we're going to put down the 20%. So 20% of $200,000 is $40,000. So now our new loan amount is $160,000. Same 4.5 years or 4.5%. Same 30-year note, right? And of course, the loan is still due in August of 2049. And yes, it does reduce your mortgage payment by, what is that, $200? $200. $40,000 give you $200 a month. But here's the kick in the pants. So your new loan amount is $160,000, right? And the amount of interest you pay is $131,850.74. You saved yourself from the first scenario, $33,000, right? But here's the kick in the pants. If you divide $131,850.74 by $160,000, the new loan amount, you still pay 82.4%. What the hell? Right? You didn't save any interest. Yeah, you may have saved the amount that you pay in interest, but the rate is still the same. So what we're going to do now is we're going to install the Delta principle, right? And again, we call it that because I made it up, and I can do that. So now the cool thing about Delta is that mathematical red triangle, that red triangle in our logo, that's a mathematical symbol that represents change, right? And the cool thing about change is that you don't have to do a whole lot on your part to create a big change. And in this case, it's only 24 hours. 24 hours. So instead of putting that 20% down the day before you close, we're going to put that down the day after you close. So what does that do to my loan? Well, let's go to example number 3. So the first thing it does is it brings your mortgage back to $200,000. Okay? And the mortgage payment goes back up to $1,013.37. But now we're going to take a $40,000 payment and apply that after you close. So what happens now? Well, the payment drops, the payment stays the same at the $1,013, right? But now what you'll see is that the mortgage isn't due in 49 anymore, it's due in 39. So the first thing we did is we shaved 10 years off the mortgage. And when you look at how much interest we pay over the life of the loan, it drops from $130,000 to $83,136.68. That should blow your mind. You just saved from scenario 1 $80,000 in interest. In scenario 2, you saved $50,000, all because you waited 24 hours to implement the Delta principle. That's how you make a choice. That's how you make a change here with Delta.
So the question still remains, what about that private mortgage insurance? Right? I don't want to miss out on that $200 or whatever I've got to pay my lender for private mortgage insurance. Well, the thing is if you're going into a mortgage situation, you're going to have to get an appraisal unless you're buying it cash, right? And in that kind of situation, the appraisal you've gotten probably within the last 30 to 60 days, and appraisal is good for a full year. So if 3 days ago there was an assessed value of whatever it is, and now I'm 3 days later and I've put that 20% down, well, I should have still reached my that 20% equity, and that private mortgage insurance should be able to be cut out because the appraisal is still good. So you get the benefit of both the reduced amount of time on the mortgage, which is in this scenario 10 years. You shaved almost $40,000 off your mortgage, right? And on top of that, you also get the private mortgage insurance reduction. It's a win-win-win. Now, here's the thing. If you approach your lender, and we've tried this, we've tried to talk to lenders and say, hey, look, you've got my down payment. How about you just hold on to it until after we close and apply the money then? And they'll do that. But what they're going to want to do then is recast the loan. They want to re-amortize the loan. Why? Well, let's think about this. They want the interest. So no, I don't want to recast my loan. I want it to just go on as would have otherwise been scheduled, because the key to this theory, the key to the Delta principle is that interest is irrelevant without time. By putting that principal payment down, because the way they calculate a term loan, that principal only payment that you make shaves the time off the back. That's why we went from 30 years to 20 on the loan. And as a result, as they do with all term loans, the thing is they always charge you interest on that same dollar year after year after year, and then they front load it to the front, so you pay all the interest up front. Well, if they can't go to 30 years, so they can only go to 20, that's where you get the savings. That's why you can't recast the loan, and that's why you can't put the money down before you close, because it cancels out the interest. So when you go to your lender, you don't want to put 40% or 20% down. You want to put as little as you possibly can down if you've got the money, and then apply the money after you close. That's how you're going to pay off your house. That's how you make a choice. That's how you make a change. The Delta Principle with Delta. So I hope this information helps. If so, give us that thumbs up. Don't forget to subscribe and hit the bell so that every Thursday when we come out with new information on things like your Delta Principle, you get it right out of the gate. Most importantly, if you know somebody who's about to go into a mortgage and they're contemplating about what kind of down payment they want to put down, share this video, right? Share this with your lender. Share this with your realtor, right? So they understand the concept that you're trying to accomplish, and hopefully this will help you get to the end of that loan without paying out so much cash.